So let's talk about Benjamin Graham. You've probably heard him called the father of value investing. But what's really fascinating is that his ideas weren't born in some booming market. Nope, they were forged in the absolute fire of a total economic collapse. Today, we're going to unpack the simple yet powerful rules he created for surviving financial chaos right in the middle of the world's darkest hour. To really get Graham, we have to go back in time. So picture this. It's 1934. The Great Depression has the entire world in a chokehold. The stock market isn't just having a bad day. For most people, it's completely wiped out. This is the world that gave birth to one of the most powerful investment philosophies ever created. Okay, so our story starts in a market that is just in absolute ruins. When Graham and his co-author David Dodd sat down to write their book, they weren't just creating a textbook. What they were really trying to do was build a rational lifeboat in the middle of a full-blown emotional hurricane. And this quote, man, it just perfectly captures the mood they were up against. People weren't just a little scared. They were completely convinced that the entire financial system was permanently broken. Can you imagine trying to sell a book about stock analysis when everybody thinks stocks are basically worthless? And into this total abyss of fear, Graham and Dodd proposed something radical, a system based not on hope or panic, but on pure, cold logic. So that brings us to Graham's big idea, his really big idea. He looked at this world of people basically gambling their life savings away and just said, there has to be a better way. And his first and maybe most important step was to draw a bright, clear line between two very, very different activities. First up, you have speculation. This is what pretty much everyone was doing back then. They were just betting on which way prices would move, hoping a stock would go up, without any real regard for what the company itself was actually worth. It was all about market timing and gut feelings. Sound familiar? And then, on the complete opposite side of the spectrum, Graham gives us this incredibly powerful, almost legalistic definition of what an investment truly is. I mean, look at those key phrases: thorough analysis, safety of principle, and a satisfactory return. This isn't about hunches, it's about doing the homework. And you know what? Graham was totally uncompromising on this. For him, it was black and white. If you haven't done the deep analysis to make sure you're protecting your initial capital, you are not investing, period. You are, by his definition, speculating. End of story. Now, this next idea is probably one of his most famous analogies, and honestly, it just perfectly nails his view of the market. He said that in the short run, the market acts like a voting machine. It's just a wild popularity contest, totally driven by emotions and sentiment. But over the long run, it becomes a weighing machine. It eventually and accurately figures out what a business is truly worth. A value investor's entire job is to ignore the daily votes and focus on that final weight. All right, so all of this logically leads us to Graham's single most important concept, the one that really ties everything together: the margin of safety. Think about it. In a world that's just full of uncertainty, where the future is fundamentally unknowable, how do you protect yourself? How do you guard against bad luck, bad timing, or just being flat out wrong about something? How do you build a defense against uncertainty itself? Well, Graham's answer was the margin of safety. And as you can see, it's this beautifully simple three-step process. First, you do the hard work. You figure out a company's intrinsic value, what the business is actually worth based on its assets and its earnings power. Second, you compare that real value to the current market price. And finally, and this is the secret sauce, you only pull the trigger and buy when there's a significant discount. And this is where we get that famous saying, buying a dollar for 50 cents. If your analysis shows a business is worth $1 per share, but the market, in its emotional voting machine frenzy, is selling it for 50 cents, well, that 50-cent difference is your margin of safety. That's your cushion against making a mistake. It's the secret to limiting your downside risk. Now, Graham was a brilliant guy, but he was also a realist. He knew that not everyone had the time, or frankly, the desire, to become a full-time financial analyst, so he laid out two very distinct paths for investors. On one hand, you've got the defensive investor. Think of this as the person whose main goal is just don't lose money. They want stability and a simple, low-effort strategy. Their guiding rule is safety first. Then you have the enterprising investor. This is the person who's willing to roll up their sleeves, put in the time, and dig through financial statements, all with the goal of getting better than average returns by finding those hidden, deeply undervalued gems. And of course, there's no way we can talk about Benjamin Graham without talking about his most famous student, the man who took these exact principles and used them to become one of the wealthiest people on the entire planet, Warren Buffett. Warren Buffett was actually Graham's student at Columbia University, and get this, he calls Graham the second most influential person in his life, right after his own father. This very book, Security Analysis, was the Bible he learned from, and he even wrote the foreword to this modern edition. And this classic quote from Buffett, it just nails it. It perfectly captures how deeply he soaked up Graham's entire philosophy. When he's talking about buying dollar bills for 40 cents, that's just a folksy Midwestern way of restating the margin of safety. It really is that simple, and it's just that powerful. But let's be real, Graham's ideas were born in a world of ticker tapes, not Twitter feeds. So the big question is, how do these principles from the 1930s actually hold up in today's high-speed digital market? Wow, modern value investors have definitely had to adapt the playbook. For instance, many have shifted their focus from simple earnings to something called free cash flow, which they see as a more honest measure of a business's health. But the core challenge? That's still the same. In a world of nonstop news and extreme short-term focus, just having the patience to wait for the weighing machine has never been harder. The famed value investor Seth Klarman sums up this whole modern philosophy perfectly. He says, "You may not get rich quick, but you will keep what you have. And if the future of value investing resembles its past, you are likely to get rich slowly." It's really a philosophy of survival and patient, steady wealth building. So when you boil it all down, it really comes back to this one thing, that deep, thorough, fundamental analysis that was at the absolute heart of Graham's work. It's all about ignoring the market's daily noise and using your own analysis to figure out what a business is truly worth. Which kind of leaves us with one final thought to chew on. In a world that prizes speed above almost everything else, a world where speculation is absolutely everywhere, is the simple, disciplined act of being patient the ultimate sustainable advantage?